Good morning, everyone, and welcome to this webinar from 7am. My name is Robert Poulton. I'm the head of sales for 7am, and with me I have our Chief Investment Officer, Chris Darbyshire. Now, we're always conscious with advisors and financial planners that you're sacrificing potential fee-earning time, so we're very grateful for your attendance this morning, and this is CPD-able, so I'll keep my opening remarks to a minimum. I think many of you, but not all, may be familiar with 7am. So just a very brief introduction from me before I hand over to Chris. For those of you who are not familiar with us, the core of what we do really is active asset allocation. And then we implement through a range of strategies, ranging from the extremely active managers through to the smart passives we'll talk about today, and as well as derivatives and traditional passives. So we very much take a best of breed, horses for courses approach in implementing the most important part to us, which is the active asset allocation. In terms of delivering this way that we manage money in the portfolios, we have a range of services from discretionary, full service discretionary management, model portfolios, funds of funds available on all platforms, as well as having our own platform, which some of you may be familiar with, which allows you to aggregate not just our own investment management, but others, and access loans, deposits, and other services. We only work with financial planners, or rather people with a financial plan. The vast majority of our business, therefore, comes through financial planners like yourselves. We don't do any financial planning ourselves, no plans to. So really our reason for existing is to provide a range of investment services and technology to financial planners and for your clients. So that's really all I'd say at this stage. To hand over to Chris for the latest in what I think is a long line of innovations from 7am. In this case, so-called smart passive investing, and Chris will put that into historical context and then tell you what we're up to. So Chris.
Okay, thank you, Rob. So why are we here? On this slide we have a list of funds that are available to European investors that invest in US equities. I've only put the top 25 funds down on this chart of those that are available. There's actually 191 US equity funds that are available in the UK, which have at least a 12-year track record. The reason I put the top 25 down is that within that 25 you have two very interesting options. If you look at the bottom of the chart, you'll see that the S&P 500 total return, so this is the benchmark, is actually ranked 14th percentile of all those funds that are available, which means that 86% of active managers in the US do not beat the benchmark. So reading up from the benchmark, you can see we've got Henderson US Growth and AXA Framlington and so on. These are all active managers that have beaten the benchmark over that 12-year period. And at the very top of the chart, we have this quite interesting ETF called the Guggenheim S&P 500 Equal Weight ETF, which, by the way, is by far and away the best performer of all 191 US equity funds that are available. And what this ETF does is it simply invests equally in all the 500 constituents of the S&P 500. So every constituent gets a 0.2% weight within the portfolio, and there's 500 constituents, so that makes up the whole of 100% of the portfolio. And I think it's a staggering piece of data, really, that this simple strategy where you simply equally weight your portfolio to all the constituents of a major index like the S&P 500, biggest benchmark in the world, biggest stock market in the world, and one of the hardest to beat the benchmark in. And this simple strategy is far and away the best performer. So what this presentation really does is try to answer why that is the case. And this is a smart passive strategy, the S&P 500 equal weight. We use it ourselves at 7IM, and we've developed the thinking away from equal weight to something we think is a bit better, but we'll talk about that. Following page, really just evolution of 7IM's implementation of our asset allocation decisions using passive investment instruments. We started with ETFs. We then tried to cut out the ETF provider cost by investing directly in stock baskets. We then moved from there to smart passive investments, and I'll explain more what smart passive means, and ending up with the 7IM equity value funds, which are our smart passive strategies that have now been unitized and are available for investment separately from the 7IM AAP or multi-manager funds or other funds. This is my colleague, a picture of my colleague, Alessandro Laurent. Alessandro joined us 18 months ago from F&C Asset Management, where he had been really working on these strategies for 7 years. He has a PhD in economics. There's now 2 in his team, and shortly there will be 3 people working in his team. So we have a team of 3 quants now at 7IM. So what is smart passive? Well, the standard approach is that we have 2 types of investing, active and passive, and they try to achieve different things. Passive investing is low cost. It aims to track a benchmark, not to beat the benchmark. Active investing, on the other hand, is relatively expensive. You pay for the manager and the research team and so on, but the quid pro quo for that is that the manager aims to outperform the benchmark. Smart passive is really a hybrid. It's in the middle. It is both aiming to outperform, but also charging a cost which is more in line with passive tracker type costs. And what I'm going to try and demonstrate through the presentation is that actually the outperformance you get with smart passive strategies is in many cases better, than you get with an active manager, and also more reliable over time. Many active managers are difficult to use because they have surges of good performance maybe once every few years. It's difficult to predict when that surge will occur. Whereas with smart passive strategies, we have a fairly good idea of when the strategy will outperform, and if we get it right, it should outperform quite consistently. We'll just click over that. This is a chart which tries to describe modern finance theory and the development of smart passive in one page. There's a lot on this page. So if we start with the small hexagon to the left, this represents the old world, what people used to think until a few years ago. And if you can see in that hexagon, we've got something called the traditional equity risk premium. And this is the extra return that you get from investing in equities in the stock market over and above a risk-free investment such as government bonds, for example. So that's what you're looking for. That's what you're looking for when you invest in equities. You want this long-term equity risk premium, the additional returns that you get for taking on a bit more risk. And you'll see just beyond that green circle, I've got a white area which I've called alpha. That's what the investment industry refers to when it's talking about active manager outperformance. When the manager comes along and says, look, I'm going to charge you 1% for this service, but I'm going to beat the benchmark, the amount by which the manager can beat the benchmark is called alpha. Now, of course, across the whole of the investment market, there is no alpha because the benchmark is, of course, the combination of everybody investing in that market together. But some managers will beat the benchmark and some will be below the benchmark. And so alpha is this term we use to describe those managers that can beat the benchmark. Now, moving to the right-hand side of the page, this is the new world. And you can see this is the same kind of hexagon, only what I've done here is I've divided the alpha, the potential outperformance, up into different factors, I'll call them. You can see at the top of the chart there, momentum. So if you devise a portfolio that invests mainly in companies that have the best stock price momentum over a period of time, for example, a year or so, then over time, provided you keep reinvesting in a portfolio that has the best momentum, you will actually outperform the market. So in other words, you can take what managers used to promise, take that alpha, and you can now say, well, a little bit of that alpha is actually due to momentum. This momentum, we call it the momentum factor. Now, you shouldn't pay as much for momentum as you do for true manager alpha, because momentum you can get just by biasing your portfolio towards the companies with the best stock price momentum. It's a systematic strategy. It's a fairly simple strategy to implement, and there's no need to charge 1% for that. The same goes with value. So if you see moving around clockwise in the hexagon, we have value. If you bias your portfolio towards those companies that are cheaper on some valuation metric, and they can be quite basic valuation metrics, price earnings, for example, or price to book. If you invest consistently and systematically in the cheaper companies, over time, you will beat the benchmark. So this is another factor. And again, it's another factor that can be implemented quite easily, quite cheaply, and you shouldn't have to pay a lot for. So you can see with the hexagon on the right, I've broken it up into 5 different factors, which are all academically proven to beat the benchmark. And I've kept a little bit, the last sort of segment of the hexagon, I've kept that back for true manager alpha. And what we're really saying in the new world is that, yes, there's still, managers can still outperform the benchmark. We call it idiosyncratic risk. They can still do that, but actually a lot of what we used to think was manager outperformance, we can now get cheaply using the factors that we've isolated and identified and have been proven to have good long-run outperformance potential. And that's what smart passive is all about. It's all about getting outperformance through these systematic factors in the hexagon and not having to pay up for it like you do for manager alpha. I've then taken the hexagon and I've just sort of taken that analogy and I put it into a slightly different diagram here, but it's the same concept that we're trying to express here. So you take manager alpha, which is white light, you shine white light through a prism, and the prism breaks that light up into different parts of the spectrum, and each one of those different colors represents a different factor. So in other words, if you give me an active manager who's outperformed the benchmark, I can take his outperformance, I can now analyze it, and I can break it down into factors, and I can say, you know what, some of his outperformance was because he's a good value stock picker. Some of that outperformance came maybe because he was investing in momentum stocks, and there'll still be a little bit left which is true alpha, remembering the hexagon. But a lot of his outperformance now comes from these factors. So I'm feeling that I don't have to pay up quite so much for my manager's outperformance. In fact, what I really want to do now is I want to get these factors cheaply, and I still want my active manager, but I want him to be doing what the factors can't give me, the true alpha, what's left on that hexagon. So before we go on, I'm going to talk about conventional benchmarks. Now, a conventional benchmark is built by weighting companies according to their market capitalization, to their market value. So if you take the FTSE 100, for example, and what I've done on this chart is I've just taken the top 10 companies from the FTSE 100. I took the numbers a couple of days ago. You can see, and I've got their weights in the index here. You can see that Royal Dutch Shell is the biggest constituent of the FTSE 100 index, and it has a 7.5% weight because it's a very, very large company with operations all over the world, in a very big, profitable industry. Second, we have HSBC Holdings, one of the biggest banks in the world, and then so on down. And those top 10 companies in the FTSE actually make up 41% of the index. So you can see in a conventional benchmark, the index is skewed towards the larger companies. What does that mean for you as an investor? Well, it means that if you're investing in the benchmark or trying to beat the benchmark, your performance is going to really depend on how well those top 10 companies do. You know, it's 40% of your portfolio here. You need these big companies to perform well, and then the benchmark will do well. Your problem's going to be if these big companies don't perform well and all the small companies that don't really amount to much in the benchmark do well, well, then the benchmark as a whole is going to be held back. But it's not just the big companies that are big, have a big representation in the capitalization weighted index. It can also be small companies that have a very high valuation. So, for example, biotech companies can sometimes get quite high up the rankings of an index, even though they have tiny amounts of revenues, sometimes even no profit. But if they're on a very high valuation, then they'll be a relatively large part of the benchmark. Then as an investor, what you're really betting on is that those high valuations are justified and that the profits will at some point come through, the market will continue to love this company and continue to give it a high valuation. The other companies, you know, who will have a big representation, the companies whose earnings may be very volatile, but they just happen to be very favored by investors at a particular time. And I put Apple, for example, into this category. So you've got Apple, you know, it's a big company, makes a lot of profits, but it's not the biggest company by any stretch of the imagination in terms of its numbers of employees or its revenues. But Apple goes through periods when it's very, very in fashion with investors, and it becomes by far and away the largest company in the US stock market, and indeed sometimes in the world. So you see, it's not just about being big. You can be very expensive, it'll be on a very high valuation and have a very high weight within an index. And you can also have just be very fashionable. I want to now put those comments into our light spectrum diagram. So in a market cap weighted index, when we kind of take the returns, send them through our prism and break them down, you can see that we have certain biases. So as I said, we're very biased towards companies that have very large. You know, that's the part of the index that will make or break the performance. Secondly, we're biased towards companies that happen to be in fashion, that have a lot of share price momentum, that have driven maybe the valuation up. They've just become fashionable. This is the Apple phenomenon. And then finally, we have a negative bias towards value. So in a market cap weighted index, you're investing in the companies that are the most expensive. They're the ones that have the highest ratings and have the biggest market value, and therefore have the biggest representation in the index, the biggest weighting in the index. So you're a negative value. You know, you're buying expensive here, not cheap. Now what I want to do is show you the same analysis, the same chart, but looking at an equally weighted portfolio. And what I'm trying to do is answer the question I posed in the first slide, which is, why did the Guggenheim equal weight S&P 500 strategy outperform all of those active managers in the US over the last 12 years? And here you have the answer. So when we break up the returns from the equal weighted portfolio, we see that they're exactly the opposite. The biases in this portfolio are exactly the opposite from the market cap weighted portfolio. In other words, in an equal weighted portfolio, you're very much more dependent on the smaller companies. You have a negative bias to size. In other words, you have a bias towards smaller companies. If you think about it, we're giving large companies that might be, you know, an Apple might be 5-6% of the index. We're giving it a weight of 0.2% in the equally weighted portfolio. Similarly, there are lots of, you know, there's a long tail of very small companies in the S&P 500 that we're actually giving a bigger weight to. We're now giving them the same weight as Apple and the same importance in the portfolio. Also, when in an equally weighted portfolio, we're avoiding the momentum bias. Those companies whose stock price has done very well, say Apple, for example, are only getting a 0.2% weight, not a 5 to 6% weight. So we're ignoring the fashions of the times. And then finally, we're actually investing in companies which are cheap on a valuation metric. So a company whose market values run up because it's very highly rated, such as a biotech company, we would be knocking that back to 0.2% here. So we're biased towards cheaper companies. We're getting away from that sort of, weighting towards the more expensive companies. And it's by inverting the exposure to those factors that equally weighted strategies outperform. So what my colleague Alessandro and his team do is they identify the different factors. They isolate them and can describe them. So Alessandro has developed a model over his years of doing this, which categorizes value, has a definition for it. He looks at the accounts of companies going back over 35, 40 years. He works out what value, what definition of value, whether you look at price to cash flow or price to book or price earnings ratio, which one is the best at finding the cheap stocks that are going to outperform systematically over time. And he does the same for all the other factors. So for example, for growth, he's looking at companies with a good sales growth record over the past few years. For profitability, he's looking at companies with a very reliable, strong business model which produces a good profits flow. And he's able to identify through his model the different factors and isolate them. He then picks out certain factors and biases his portfolio towards those factors. And here they are on the slide. So main factor that he's biasing the portfolio towards is on the right-hand side of the spectrum here, which is value. So he's identifying cheap companies and biasing his portfolio towards them. However, he's also got several other factors in there because you don't want to buy value traps. You don't want companies that are appearing to be cheap, but they're cheap because the stock price has fallen very rapidly because there is a problem. So in other words, he also adds in some quality factors, some profitability, and some growth. And what those three do is stabilize the portfolio so that we're picking up value, but we're doing it without unnecessary, unwanted volatility because we've picked a bad stock that's going to go down in value. Can't get it right every time, but we're just trying to move the odds in our favor with this strategy. How does he do this? In a bit more detail. So he collects financial data from balance sheets, income statements, and he's got a big focus on cash flow. He then calculates a score for each risk factor and is able then to aggregate each company's exposure to the risk factors together. So each company then gets a score and we can then weight the portfolio according to the scores that we get. And what I've done is I've described this diagrammatically in this slide. So here we have 5 companies, 1, 2, 3, 4, and 5. And what we've done is we've isolated a score for the value factor. So each one of these companies has the same exposure to value. However, a company won't always have just value. There'll be exposure to other factors that we may or may not want. So what we do is, let's have a look at another factor. So here's momentum. Now, if you look at company 1, it's got a lot of negative momentum. In other words, it's showing up as a value stock because its stock price has fallen a great deal over the last year. That makes us very wary that the business model is actually broken, that there's a problem in this company that isn't showing up in the accounts data that we're using yet. So we would call this sort of tainted value, if you like. It's value, but it's value that comes with a lot of risk. A lot of investors think this company is going in the wrong direction. Now look at company number 5, which is also showing the same, positive value characteristics, but its momentum has been positive. So its share price has moved up over the past year. In other words, it seems that there's nothing particularly broken with this company. It's maybe just a bit out of favor, and in fact, investors are beginning to buy into it again, perhaps after a period of being out of favour. So company 5 is wholesome value, and that's the kind of value we want in the portfolio. And when we put these factors together, what we really want is to weight our portfolio more towards company 5 than towards company 1. So you can see in the bottom part of the page here that we end up with a portfolio which is skewed away from company 1. It has some value characteristics, but they're not particularly desirable. And we're skewing it towards company 5, which has got the kind of value that we want. It doesn't come with a bad business model. So we do this across the companies in the index. We select from the companies in the index, and we have certain rules that we impose on that portfolio, such as we will rebalance monthly. So we will run our model again every month, and we'll pick again the companies that we think would have a strong value tilt, subject to growth and profitability and quality concerns. And then we'll rebalance the portfolio. We won't allow any company's weight to differ from the benchmark weight by more than 4%. So a company can be 4% above its benchmark weight or 4% below, but no more than that. And then what we do is we impose quite strict sector and country constraints. So we don't allow any sector to be 3% above or below its benchmark weight. So what we're really trying to do is we're sticking to the benchmark, but we're using our value biases and our factor biases to pick up a bit of extra return. And when you put all of these constraints and methods together, you get something which should outperform the benchmark by about 2, maybe 3% per annum over the long term, but with lower volatility than the benchmark. You can see going on down the list, we have further constraints. We look at liquidity. So we are constraining the portfolio. We don't want to be investing lots of the portfolio in companies that are not particularly liquid. So we look at the average daily trading volume of the company, and that and our position is then scaled so that we never trade more than 5% of the daily volume of the company's stock. And then just to give you a bit of flavour for the actual funds themselves, we have 3 funds that are up and running, 3 equity value funds. We have a UK fund, a US fund, and a Europe ex-UK fund. And on this page, you have the top 10 positions in each of the funds. So just taking the UK, for example, top 10, well, it looks a bit like the FTSE 100 in a sense. We've got Royal Dutch at the top, HSBC in second, and a lot of those names are in the FTSE 100. And that's because we're not trying to differ radically from the benchmark. You will see that those weights, however, are different from the weights, the pure FTSE 100 weights. What we're trying to do is just tilt the portfolio towards those companies where we think there's good value opportunities, and tilt away from those where we think there are factors, undesirable factors, such as momentum, that we don't want. We backtest all our strategies over time. This particular backtest goes back to 1992, using the strategy, and this gives us an idea of the kind of performance that we can expect over time. And what this chart is indicating is that you would expect to get perhaps 2 to 3% per annum outperformance if everything goes according to plan. And then finally, costs on the funds. So we have a maximum TER of 35 bips on each strategy. So that is capped. No matter what the administrative expenses are, those numbers will not be exceeded. And there's already significant significant assets under management in the funds, as we're now using them internally within our 7IM, AAP, and multi-manager funds. Where we want value, we will use these funds if there isn't a better alternative out there. among active managers or among ETFs. I'll hand back to Rob.
Yeah, thank you very much, Chris. I think it's just worth saying that these are baskets that we've been running for well over a year now, and by unitizing them, the real benefit is that we've been able to not only make the dealing and trading on our own funds more simple and lower risk, and by doing that we use zero AMC share classes in our own multi-manager funds, so there's no increase in cost to the client. But by unitizing them, of course, we can bring the advantages of these strategies to model portfolios, both our own and we would trust in fairly short term other models, be they other discretionary models or indeed models being built by advisors themselves. In terms of availability, I think we're already a little bit out of date, are we not, on this, Peter? We have obviously our own platform, Eccentric, and the various white labels of Eccentric, or of IFDL, I should say, Transact. We've got Nucleus now, Standard Life, and Aegon, and I would imagine by the time the next 7am model rebalance comes around, we should have them on almost all the platforms on which we've currently got our multi-asset funds, with which you may be more familiar. So I think now, if we can proceed to any questions for Chris, those who are running the technology. We've had a few questions in. So in no particular order, I suppose that fundamentally we see a lot of chat in the industry, probably behind this question. Chris, is this, when it comes down to it, is smart passive an active strategy, a passive strategy, neither, both, or none of the above?
So I think it depends slightly on your point of view. It's definitely active in the sense that these portfolios, they may look a bit like the benchmark, but they're not the benchmark. And to the extent that they differ from the benchmark, that makes them active in a true, pure sense. However, we're trying to keep the costs to a passive, in line with passive alternatives out there.
Okay, because we see, again, I've read my own studies of the market chat, and it seems that active managers sometimes throw arrows at smart passives because they're, not truly passive, and passives providers or providers who only have passive solutions throw arrows at it for different reasons. We kind of do best to breed. Is there, and this is linked to another question that I see we've had in here, which is that are smart passive strategies better suited to certain asset classes, certain markets, because the whole portfolio isn't, and presumably isn't intended to be implemented with smart passive instruments?
Yes, I don't think we'll ever get to the point where the whole portfolio can be smart passive. I've used in the presentation, I've used equities as the asset class, and I've particularly focused on the S&P 500, which is a very difficult index to beat, difficult benchmark to beat. And so where smart passive comes in, very, very handy indeed. But it does extend to other stock markets. There are variations in the effectiveness of smart passive. So, for example, it's quite effective, well, very effective really in the US, as we've seen, can be equally effective in the UK and Europe, but in Japan, it's trickier to implement a smart passive strategy which you can be sure of being consistently effective. So we don't have a Japan solution, for example. Other asset classes, it does a very, very good job in bond markets. Bond benchmarks are constructed by allocating towards the biggest issuers. So take a global government bond benchmark, and you'll find that Japan and Italy have remarkably high weightings, and that's because they're both very, very indebted countries that have issued a lot of bonds. And this is not necessarily a good thing for investors to be investing, really in the more towards the bonds of the most indebted countries. So a lot of the smart passive work in bond markets has gone towards breaking that idea and investing maybe according to GDP or some other kind of weighting mechanism. And that's what smart passive is all about. It's about having a slightly different weighting, different approach to weighting, different weighting methodology, and trying to get a better returns as a result of that. So it does work in fixed income in the major asset classes. Okay. There's nothing really yet in alternatives or property, for example.
Right. Okay. Thank you. Another question we have here: how frequently do the stocks turn over? What are the associated transaction costs on strategies like this?
Yep. So these strategies, we have turnover of about 5% a month. That includes buys and sells. So gross 5% a month, and the costs are about 1.5 bips of value turning over, plus whatever the market impact could be. And we obviously try to minimize market impact by ruling out illiquid or less liquid stocks and keeping our trading volumes to be a very low level of the average daily trading volumes.
Okay, thank you for that. Another question here, more of a challenge perhaps. We selected 7am because they consider the whole of market when implementing the asset allocation decisions. Are 7am changing their strategy? Are we moving towards an asset allocation that implements purely through in-house strategies?
I've got no problem using an in-house strategy when it is the best way to implement the tactical view. Our value funds are best of market. We've had a very good experience with them, and so I'm very happy to use them. However, if I didn't think value was where we should be, I wouldn't be using them. I would like that Alessandro's team could then develop a different kind of strategy which would suit the stylistic bias that we're looking for. But we don't have any outside of value. We don't have anything yet. So I think tactical asset allocation is what's going to be the principal driver of our returns in a multi-asset world, in a multi-asset context, and we will continue to find the best way of implementing our views.
Right. Okay. Understand that. So just as follow-up then, just to summarise, so the core of what we do will remain active asset allocation, and that you wouldn't ever feel any pressure to compromise on our active asset allocation in order to shift volume of our single sector funds.
I don't really, when we're doing asset allocation, I personally don't think about implementation. Life is complicated enough trying to pick the best asset class without having an eye on, how you're going to implement it. Asset allocation drives implementation. It's not the other way around.
Right. So, given that this is largely a question here, have you or would you ever take an active view on a particular stock? For example, remove or reduce a weighting in the stock that the model has selected?
No, we are. The model is we are completely systematic in this approach. We do not try and second guess the model when it comes to the weight of a stock. We trust the model, and all our efforts and time and labour has gone into developing the model to be the best it can be. So there would be no advantage to be gained from doing that. One thing we do is that we don't always rebalance on the same day every month. So that rebalancing date is at our discretion. And the reason for that is that sometimes the date coincides with a bank holiday or a weekend. We want to avoid days when we think trading is going to be particularly illiquid during the month. So there's discretion in the date of the monthly rebalancing.
Okay, thank you. I think probably another just a final couple of questions then, Chris. Another one we've had in. You talked about the equally weighted index. Why not just offer an equally weighted if that's proven to work so well?
I like the equally weighted, and we do use it a lot in-house. However, the equally weighted does add quite a lot of volatility. So the one drawback with equally weighted is, yes, you will outperform over the cycle, but you will do worse in a drawdown. What Alessandro and his team have done with the model is they've eliminated the bias towards smaller companies that you get through equally weighted, which makes the portfolio that bit more volatile. So we've now got something which will outperform, but with lower volatility and lower drawdowns over the cycle. So it's it's got about the same level of outperformance, but the risks are much more controlled. So we prefer that.
Okay, so let's have a final question then. I currently use a FTSE 100 tracker for UK exposure. How do the MSCI indices differ in the way they are put together?
Not by much is the answer. We use the MSCI indices as our benchmarks for these funds. So our starting point for the UK is an index compiled by MSCI of, I think it's 120 odd stocks, whereas the FTSE 100 is 100 stocks. So the benchmark is constructed in the same way. It's a market capitalization weighted benchmark. That's what we're trying to beat. And the truth is that the MSCI benchmark for Europe and the FTSE benchmark for Europe are really very similar in the way they're made and the amount. Can I just point out, Rob? There's another question that we got in here. Alessandro on his roadshow has talked about book to price as being one of the value metrics that he looks at. So book value of a company divided by its market value. And I've talked about price to book. Are the two different? Well, actually, no. What I do is I talk about price to book because I'm an ex-analyst. And when you're an analyst, look at price to book. And all Alessandro was doing is inverting that ratio and calling it book to price. And then so he's looking for book to price to be a high number. So lots of book value, not much market value. That's in his world, that's cheap. When I look at price to book, I look for a very low number.
Understand. Okay. Splendid. Well, thank you very much, Chris, for your time and for taking a few minutes out from running the portfolios with your team. And thank you to everybody who's again taken the time to listen in to the webinar on this fairly topical subject. We will sort out the CPD aspect of this for you, and of course any subsequent questions that you have, please feel free to contact our relationship support team, and we will provide the information that you need, either on the telephone, email, or coming to see you. So thank you once again, and have a good day.